Well, it was certainly not a solution or an answer. It was a victory in the narrow political sense, which was it was more their way than the president's way, and it was better than the next best thing. So in pure political space, it was a victory. But if you're asking whether it was a solution, absolutely not. This is not even a drop in the bucket because, as you point out, James, spending cuts are not spending cuts. In every state of the world, we spend more. But if we spend a little bit less more than we would have otherwise, if that's the right turn of phrase, then people call that a cut. But they're not cuts at all. Spending's going up, deficits are going up, debt is going up, and there's no end in sight. I mean, the United States actually, we're sitting here in London last night. The U.S. exceeded a 100% debt to GDP ratio, I think, for the first time since World War II. In other words, there had been a lack of borrowing because the debt ceiling had not been raised. So the Treasury had a backlog of issuance. Once the debt ceiling was raised, I think the President signed it on Monday, if I'm not mistaken, the Treasury went out with a monster $280 billion auction yesterday, and that new debt pushed us over the 100% debt to GDP ratio. Now here's the problem. GDP is about 15 trillion, give or take. Our deficits are running about 1.5 trillion, give or take. So that's 10%. So we're adding 10% new debt every year at putting 1.5 trillion on top of a $15 trillion economy. So we're increasing the debt to GDP ratio 10% every year, but GDP is only growing about 2%. Now, if you look at the Congressional Budget Office projections, they would say, well, GDP is going to grow 4 or 5, and we're going to put the debt issuance on a downward path, so eventually that debt to GDP ratio will come back into alignment. But that's not happening. That's a classic...
The economy is slipping into a double dip, as they call it.
Correct. Well, yeah, you're right. I mean, technically, it may be a double dip recession, but that's not how I think of it. I think of it as
it's the same recession, isn't it?
Well, I call it a depression. This is the second Great Depression.
I agree with you. Yeah.
Started in 2007. It's going to run, depending on policy, until 2014, maybe longer.
So 1.5 trillion deficit is really unrealistic for this year, isn't it?
Yes, because growth will be lower, tax receipts will be smaller. Although there are other factors in play now. These, the 99ers, they're running out. That's 99 weeks of unemployment benefit. That's expiring later this year. Remember, unemployment started out as a 26-week program.
Yeah.
That's classic unemployment. Then they had to extend it to 52, and then they extended it to 99, which is almost 2 years.
So maybe they'll just extend it again.
Well, back to the Tea Party. I mean, you think that was a fight over the deficits, the debt ceiling. Watch what happens on extending these benefits. I'm sure the White House wants that. I'm sure they'll make the case for it, but I'm not sure that that's going to pass. And so if they don't extend it, you go, when did the recession hit full force? When was unemployment going up the fastest? It was 2009. I mean, this depression started in 2007 because that's when the housing bubble popped and we started to get asset price deflation in some important sectors. But it was 2009 was the bottom of the first recession phase of the depression when unemployment spiked. So that cohort, those people who lost their jobs then, who haven't got jobs in the meantime, are now the 99ers. They're going to come off unemployment later this year. That's going to cut consumption, cut government expenditure. So there are forces driving the deficit higher. There are other forces driving GDP lower. So you're exactly right. This debt to GDP ratio is going to get a lot worse. We're going to get up to Greek levels.
Well, the other thing that's scaring me is that, and I follow these numbers very closely because to me it's an indication of where the gold market is going. But basically, of every $100 the U.S. government is spending, about 60% comes from revenue and 40% comes from debt.
Right.
And historically, once you go over that 40%, you're really on the road to hyperinflation. I wanted to get your thoughts. Do you see a hyperinflationary outlook for the dollar as the U.S. government tries to fulfill its promises and just turns to Mr. Bernanke and the printing press to give ever worthless dollars to fulfill those promises?
It's certainly possible. The way I think about it, James, is they're almost like tectonic plates pushing against each other. Now, when you've got two powerful plates pushing against each other, just because there's no earthquake today doesn't mean there's not a lot of tension building up. There is. We have natural deflation coming from the Depression, and we have inflation coming from policy. Now, the fact is they're pushing against each other. The actual inflation measures, CPI, if you can believe it, are around 2%. So economists would say that's fairly well behaved. But that's not stable at all. It's what physicists call a minimally stable state. In other words, the forces are still there, and that's going to break at some point. When? It's hard to say. I wouldn't necessarily tomorrow, although it could be tomorrow. But which way will it break? Will will Bernanke in effect throw in the towel and say, look, we've done all we can do. We've just got to take our medicine and let this deflationary part of the cycle play out, in which case deflation might prevail? Or will he double down or triple down or do whatever it takes, as they've said? And I think that's more likely. And then you just get into the risk of hyperinflation. What's interesting to me is that gold wins either way. Gold has, very intuitively always been a strong inflation hedge. But what a lot of analysts don't understand is that it's a very good deflation hedge as well. During the 1930s, that was the greatest prolonged deflationary episode in U.S. history. Gold went up 75%. Homestake mining was the best performing stock on the New York Stock Exchange. So gold has a history of doing well in deflation as well also.
Yeah, I agree with you on that. The way I describe it is gold is a monetary problem hedge. Regardless what that monetary problem is, inflation, deflation, bad banks, sovereign credit crisis, you name it. People will go to gold in order to protect themselves when there's uncertainty about the monetary outlook.
Right. I think I come out in the same place. Here's how I describe gold. I say gold is not a commodity. It's not an investment. And it's not a trade.
You sound like me.
Gold is money. Yeah. And if you want some money, you better have some gold. And in real terms, its value changes very little. I was talking to someone the other day, and I said, well, I think I can see gold at $7,000 an ounce. Not tomorrow, or it might be a couple of years, but I can definitely see it at $7,000 an ounce. And the person was surprised, and they said, really? Is that true? You really think it's true? I said, well, I do think it's true, but bear in mind, the gold won't actually be worth anymore. The dollar will be worth less.
Yeah, we'll be paying $7 a gallon for gasoline or whatever.
Exactly. But it is a way to preserve wealth, and it is a way. It is the one true store of value.
Yeah, I was discussing that this morning with a reporter, and the way I was explaining it is that gold is not an investment because it doesn't create wealth. He was saying, well, the price of gold goes up, and I said, well, the purchasing power of the currency is going down. Right. And he said, well, doesn't gold go from undervaluation to overvaluation? And I said, yes, it does, but it's not creating wealth. It's just merely redistributing it from people who are holding paper currency to people who are holding gold. Right. And that's, I think, how it's going to continue playing out until at some point in time in the future, gold becomes overvalued, and then you're going to want to use it to get into undervalued assets, whatever they might be at that future date.
Correct. I think that's exactly right. I agree with that, and I think there are objective ways of figuring that out. For example, the $800 gold price in the early 80s, that was objectively a bubble. You could say it was a bubble. Why is that? Because when gold was $800 an ounce, the market value of all the official gold of the United States was greater than the money supply. It was more than 100%. Everybody with a dollar could have walked down to the Treasury, handed it in, got gold at market value.
Greater than M1.
And greater than M1. There would have been gold left over. So even, as a gold advocate, a gold standard advocate, I can see a case for,